Good morning, folks, ladies and gentlemen. My name is Roger Scott, and I want to welcome you to the midweek roundtable. We have our usual co-host, 𝗧𝗴𝗀𝗻 here. Jeff, how are you today?
I'm really good. How you doing, Roger?
Good. I'm doing great. I couldn't wait to hear your opinion. You know, you and I talk all the time, but this is the only time we really get together and kind of just forget that the mic is on, and we just completely talk very openly about the market. And that's what I love about this. And folks, by the way, just so you know, if you have questions take notes, write things down. There's a lot of discussion here. Always reach out to Jeff at 𝗧𝗴𝗀𝗻𝗀 or me at support@marketgeeks.com. It's a funny email, but it'll get to me without going through 5 different people. That's Jeff at 𝗧𝗴𝗀𝗻𝗀 or support@marketgeeks.com. We don't bite. Feel free to reach out. Jeff, how are you doing, my friend? What's on your mind this week?
This market has been kind of like, it feels like a summer tape already. It's starting to feel like, I mean, there's underneath the hood. We'll talk about sectors in a minute. There's massive moves happening in some things, but the overall stock market's kind of just like flattened out. S&P's been in the slightest range with the smallest volume since mid last week. And that's something that's kind of, I don't know what to make of that. I'm trying to wrap my mind around this this tepid atmosphere.
2 things that come to mind.
Right.
We came into this week I think this is a 4th major holiday or 3rd major holiday. And obviously things are, and as well as anyone, whenever you have a fragmented week, and I call anytime the market has a holiday day off, doesn't matter, Monday, Friday, Tuesday, Wednesday, doesn't matter the holiday, but this happened to be a major one. But whenever there's a fragmented week, it's always like the week, it takes about 3-4 days to get back from that, if at all that week. And it's always been the case, and it doesn't matter, in my experience, if it happens in the busiest week or the lightest week, it just breaks things up because the hedge fund managers, they look for any excuse to take the day off. The junior traders are not going to make big decisions without them.
Right.
And so and please, if you don't agree, I want to hear your opinion.
No, I'm with you.
But I think it's a combination of that. And I think it's also a combination of the fact that we have a really important report this Friday in light of the tone that was set last month. Remember, we were expecting 1 million new jobs, and we got 266,000.
All right. One of their massive misses, the experts. How did they? Yeah. I wish I could be an expert at something and be off by 80%. Unbelievable. Like only better racket is being a weather person. But think about this, Roger. Think about this. We're near all-time highs and we're consolidating, but it's kind of like the range has gone away. Volume is totally disintegrated. So it's like we're looking, we're technicians, right? So we're looking for emphatic breakthroughs with volume to support this next leg of momentum. And I'm just not seeing it yet. I'm seeing it in certain sectors, but I'm not seeing it in the broader market. Which is, something for me to pay attention to, because I think you're going to get some sort of emphatic move at some point here. You're going to get a 5% in a week. It could be up for sure. But what's going to be the catalyst? I'm always thinking okay, so we're in this thing. Like you said, we have to digest this holiday week, which is always true. But what's going to be the next catalyst to get us to do something decisive?
Well, and that's where I have the biggest problem, Jeff. And I'll tell you why.
Yeah.
And this is I kind of touched on this in this morning's video as well, but here's the problem: the market's reacting in a very counterintuitive fashion right now because of the stage that the Fed has set.
Right.
They kind of put themselves in a corner. Well, if the economy's, I'm the average, put me in the shoes of an average investor. Let me just kind of play through the scenario for people at home who are not completely, in sync with what we're saying. So if the numbers from the Fed look really great, if the Fed data is really, really hot, which is supposed to be really, really good, right?
Yeah.
Then they're going to slow down the sizzle. And if they slow down the sizzle, meaning the money that's flowing in, the aid that's been flowing in because of the COVID, then that's interpreted as bad. So really good is bad and really bad is good, because if it's really bad, they're going to continue doing what they're going to be doing. So that's good because interest rates will stay low. But if the economy sizzles too hot, which is usually good for the economy, it'll overheat and then they'll have to be forced to raise rates. So you're kind of in a weird, you're kind of the trader. It's putting
the market is hostage to the Fed. That's it.
Bingo. And I think that's right. They put themselves in a corner.
Yeah.
And I don't even want to talk about how long we've been saying it, because it's just, it's been, I don't remember the last time we haven't said it.
They put themselves in a big time corner.
They put themselves in a pickle. And it's kind of like, so it's a very counterintuitive market in terms of interest rates. So let me back up just 1 second to what you were saying. One thing that I'm seeing that I'm not liking is in light of all of this gyration and all of this drama, is consumer staples have started to rise over the last couple of weeks, or maybe even a month. And that's not a really good indication, because you know how consumer staples work.
It's a defensive sector. Yeah.
Right. So again, how do you interpret that in light of the scenario, in light of this drama?
There's a lot of traditional techniques that are not really like, a lot of the ancient ways that we know that are not really useful, because we're dealing with such an unprecedented atmosphere with the Fed, with the economy, with the reopening. One thing that's been low-hanging fruit that we've been talking about a lot is the inflation trade. The inflation trade is not going anywhere. So like, we're sitting here and we're trying to figure out whether Zoom is overvalued or undervalued. That's tough. That's difficult. Like, should you buy it? Those are really hard trades right now at this point in the game, trades like that. But looking at a chart of oil, which is breaking out, and seeing that the XLE, the last time oil was up here, was 25% more expensive. Now that's a low-hanging fruit mentality type of trade. These are easy, obvious trades. Like, we're sitting here, we're at the beginning of the summer driving season. I don't know if you ever take any road trips, Roger, but I like to throw the kiddies in the back of the car and, go up old I-95 and see all the relatives in the north. And I'm doing some calculations, some dirty, quick back of the napkin calculations. And this summer road trip is going to be double the cost of the last one I took in 2019 or 2020. My bad. I took it last summer, COVID. But what do you think is going to happen by the 4th of July? Where are we going to, it feels like we're going to have like this inflection point, an explosion. I think like we're going to see shocking prices at the pump. I think prices are painful at the pump, but whenever there's pain, I have a basic inclination in asset prices that whenever the market finds a pain point, it makes it much worse. That's why people are always like, what, you don't want to be on the wrong side. You don't want to be with the crowd, but I just feel like gas is going to go so much higher. I think we're going to have a dramatic gas price this summer. And I think you can go back and timestamp what I said, that we're going to see unprecedented levels in gasoline. People are going to be like, where did it all go wrong? And it's going to affect everything.
Well, it's interesting. It's funny that you're talking about this right now. Biden just suspended the oil leases in Alaska's Arctic refuge. And that's very, very bearish for America, which is obviously very bullish for oil. There's a lot of things happening, including that, right? I mean, this is literally happening right now in real time. So you couldn't,
it's a tax on everybody. It's an extra tax. You can do all the stimulus.
That's exactly what it is.
Do all the fiscal stimulus you want. But if you just made, me living my normal life, 50% more expensive from a gas perspective, everything that we do and buy, the gas tax gets passed through to consumers. Absolutely. Nobody absorbs that except us. So we don't just pay for it at the pump. We pay for it in chicken. We pay for it in notebooks. We pay for it in computers. We pay across the board for everything.
Well, Jeff, just so you know, my CSI scan on a cumulative basis, energy's number one right now. On a monthly basis, energy's number one right now. Yeah. And to add insult to injury, if you will, not my top stock, but my second, and this is out of 500 stocks. So, when I say top stock, the first, second, third doesn't matter. You get 500 stocks. Devon Energy, Marathon Group, Diamondback Energy, my friend.
Diamondback Fang, yeah.
Three, and they've been there, and they've been in their.
You see the moves yesterday? I do this monthly money flow trade, and I'm looking at volumes. I'm looking at abnormal moves in the beginning of the month in terms of asset moves, price action. And I saw moves that were 3 standard deviations yesterday. The trades come out tomorrow, but it was also in steel. Let me read to you. I got this in front of me. Just give me one moment. I'm going to read to you the top sectors in the S&P 500.
Yes.
In 2021. Steel index up 108%, copper index up 69.9%, and oil and gas exploration up 56%. So the top 3 sectors in the S&P this year are all basic commodities related stocks. There's no way around it.
You remember me telling you about 6-7 months ago, basic materials.
Oh, but this trade, this is the low hanging. This is like, you look at these. So, I mean, one thing I do as a trader is I look at things where I say, where could I get hurt the worst? Like and let me avoid that. Right. So like I'm looking at oil right now, and I'm looking at gas. I'm looking at oil stocks specifically, which are actually cheaper than the commodity. And I'm saying, ooh, the squeeze that could happen in those things could be tremendous, like so terrible. So at the minimum, I can't be short those names. That's like step one.
Of course.
I can't be short that kind of price action.
Don't stand in front of a freight train, my friend.
Yeah. And then I've been playing it long. Like I've been telling you, I've been playing it long and timing it in and out of it. So, but you know, the first process everyone should have as an investor, as a trader is, where can I get my face ripped off and let me not do that? And so even though, like, you know, we've been on it, you were the earliest I know specifically on basic materials. Freeport, unbelievable trade. You know, these trades can still go a lot higher.
That which takes me to, so, you know, I just told you the 3 stocks, and I told you that it starts with the second, third, and fourth. I didn't mention the first one. The first one was a metal company, NUE.
Yeah, Nucor.
Yeah,
up over 100%.
The first, that's the number 1 stock in my scan right now.
Right. It was up. It was up what, 8% yesterday.
Yeah, the stock is just killing it, destroying it. So I am 100% on board with what you're saying. And yeah, I believe these commodities are going to be rising. They are a very good hedge against inflationary pressure because they're going to be outperforming inflation because they're going to have a little premium for the next several months. I agree.
I don't think the Fed's going to do any. So because the Fed has the market like under hostage, I don't think the Fed is going to do anything until they're forced to do something. So then I'm thinking to myself, like, what would be a catalyst to force these psychos to do something? And the answer is, if you have like an explosion, a parabolic move in gasoline, where it goes from like $3 on average a gallon in the United States to like 5 or 6 within a month, people are going to start really, like, you know, even from their own side of the aisle of the party, people are going to start saying, wait, hold on, God, like, are you guys thinking this through? I mean, is this really transitory? How much more pain can we take?
Right.
And then I think that, you know, that'll have effects on the other sectors, broader market, in my opinion.
I think that, and the economy just overheating, and I think we're going to have another, I think we may have another of these flukes, if you will, with employment. I think it's going to get to a point where it's just going to get to a head where it's commodity prices. It's pretty much what you're saying. I'm just rephrasing it in a different way.
Yeah, you're putting different parts,
but yeah, the impact is going to be the same. It's not going to be the economy cooling off. It's going to be the economy running too hot and overheat. Yeah, overheating and impact and spilling into several commodities and other sectors like the jobless, the real estate market, construction spending, all of that stuff. Because look, if interest rates go to a certain point, or if you have to pay for lumber for X, what's a big company going to do? A big lumber, they're going to stop production. There's only so much they could hedge. So,
I heard a guy yesterday saying, "Oh, you need velocity of money for inflation." And I'm like, yeah, I guess. Well, you need velocity of money for a strong economy. You can have no velocity. Hyperinflation leads to like no velocity of money. Like the Brazilian real was invented because of hyperinflation in Brazil, and they had to do something so outside the box that they had to invent a whole new currency on the fly that you could exchange the old worthless currency for.
Right.
Lock in and have some visibility on what was going to be paid next month.
Yeah,
milk, like people were so panicked that they would go every week and, the cost of milk would be up 30% in Brazil. And so it was like from week to week. So it literally like stopped the economy. Like the economy had like an aneurysm in Brazil.
I completely agree with you. Let me change the topic slightly, just slightly.
Yeah, of course.
About a week and a half, 2 weeks ago, I've been talking about shortages in meats and different products. Now,
right.
And I made a big stink about it. I talked about all the different companies, Heinz ketchup. I quoted the president of Yum Brands. I explained how I scared Tony 𝗧𝗴𝗀𝗧 that he's not going to be getting his chicken patties. So we went long Tyson Foods. So yesterday there was a meat packer, JBS, had a cyber attack, and it closed all their U.S. beef plants.
Right.
And vast majority of beef, pork, poultry, prepared food plants, they're going to be reopening. And this is a big operation in Australia and Canada, U.S., Brazil. They process about 25% of U.S. beef and 20% of U.S. pork.
Yeah.
And they're talking about it being maybe, they don't know for sure, but they're talking about it being this ransom demand based in Russia. But the bottom line is it's a cyber attack, and it seems like it's going to be repeating. Do you think, based on the already vulnerability of the supply demand chain, do you think this is going to add more fuel to the fire?
Oh, hell yeah. I love eating meat. I'm a carnivore.
Yeah, me too.
I just am. I like a good steak.
Oh, I do too, man.
I mean, we're healthy. We're balanced. We eat fish, but like, we got to have a steak once every couple of weeks. Got to have a good steak. But I want to know that I can do that. So I might go to Costco this weekend and just throw out all the bread from the freezer and just stack meat. Because I'm looking at more. I'm looking at more restaurant stocks, because restaurants are really heating up, and I think they got hit yesterday. Darden got hit yesterday. That was I was looking yesterday, what's not, because I have reverse monthly money flows.
Yeah,
restaurants are a sector that people are starting to take some money off the table in.
Yeah, so I'm interested in knowing how that's going to turn out in light of these shortages, because during COVID it was toilet paper, now it's hamburger patties, and so it's a very interesting.
But there's a point, right? Like everything gets passed through, so it's like, are you going to go sit down at Roots Chris and spend $85 for a petite fillet? Probably not.
Right. Plus, they put too much butter on it anyway. But that's for another discussion.
But you know what I'm saying? Like the gout, there's always a tipping point in pricing products. And we know this, and you can kill your business by being too greedy and and I don't see how it could be a good thing and the margin's already under pressure. It's already a terrible margin business. It's historically a terrible margin.
Very, very
single digit margin business.
Yeah.
So they can't afford to have input prices go higher.
No.
I don't know.
Let me switch the topic again. Cryptos. I know you and I see very, very eye to eye on cryptos. It's been kind of going down, bouncing around, took a big dump. Yeah. Do you think the love is gone, or do you think it's going to continue through the summer and we're going to see more rallies?
I think you see more rallies. I think that there's going to be these painful moves, but institutions are really just starting to get in there. They're really just starting to get in there. And it's another inflation play. It's an inflation protection.
Right. I think
the big thing about crypto that I've been shocked about was that you could have a 35-40% drawdown in Bitcoin in less than in a couple of days, really, is how it happened. And the system didn't break. Everything just kept running smoothly. There was no mass cat. If you had that in the stock market, you'd have so much shit happen. They have to close this exchange, and then
it would be a nightmare.
It goes belly up, and then there's so many.
Biden would have
so many knock-on effects, right, from the banking industry.
Oh yeah.
That crypto is kind of anti-fragile about. That's robust, and I think that's that we've seen so far, and I think that's something that's going to induce institutions to take bigger
more confidence.
They're going to have more confidence in how robust that system is. And liquidity, you can trade so much size in Ethereum or Bitcoin 24/7, Monday, Tuesday, Wednesday, Saturday night,
Anytime.
2 o'clock in the morning.
Yeah, anytime.
Strait of Hormuz gets shut down Saturday night, 2 a.m. You can't do anything in the S&P future, but you can trade crypto.
You can.
In size, in massive size, which is has a value. That has a value.
So you think these moves are? So you think the timing is pretty ripe right now because A, it's a hedge against inflation, and B, because the confidence level is increasing in the volatility levels.
I feel like these
and liquidity is increasing as well.
I feel like they're orchestrated attacks on the price, like it's market manipulation, so that people can get a lot, like they can shake out loose hands, weak hands, and buy much more at lower levels.
Yeah, that's what this feels like. This doesn't feel like because the activity is still there. See, last time it happened, the activity went away, the volume went away, the interest went away. This time it doesn't seem to be moving away.
In the stock market, fund managers, guys, like we talk to, it'll be like, oh, I wish this stock had come back to X, and then I would just like back the truck up and buy as much as I could. It would be all I could eat, right?
Right.
The stock market, that invariably can't happen because like there's a lot of regulators looking for manipulation and this and that. You could cause that manipulation, but you'd get arrested for it. But in crypto town, like you can do that. You can move it. You can trigger it. You can do things, and outside the supervisor, that hawk eye, people are doing it. Chinese could have done it. Chinese could have said, listen, we're going to shut down your mining farms for 6 hours, and then we know what's going to happen. Just don't sell any. We're going to load the boat. So I think longer term, and that's the way you should play these things, very long term.
Right.
I think they're going to be higher. I do. I think so.
I agree with you. I think we're going to have a nice bounce. Before we conclude, Jeff, I know we're going a little overboard, but I wanted to ask you, I know you've been doing really well with the burn notice. I know the pair trades have been working really well. Anything you want to tell people at home, any advice you want to give, any hot trades you want to talk about, anything you want to say?
So there's summer trading starting. So, let me just do some psychology for it. Like as hedge fund managers, as big mutual fund managers start to take the time to not be heroes and to not do anything emphatic, you should also probably like appropriate your trading size to the environment that it's in. If you're trying to force home run trades in a singles environment, you're going to find yourself in a tough spot because it's much easier to trade when you get the ripples in the ocean and go with the waves than trying to figure out where the waves are going to come from before they happen. So that's just like a quick, like psychological thing that I want to talk about. You and I were talking last week. I showed you some cool little study that I found on ARK as being one of the worst risk adjusted. You've been saying it, and hypothetically we've been talking about it, but we found substantiated proof that they have a horrifically bad Sharpe ratio in 2021. And so I just recently put on a money link where I'm long small cap IWM because I think this summer inflation thing, the reopen thing, I think the small caps come back. I think that the bond correlation that you've pointed out stays steady and increases a flight into those types of stocks. And I think the pain, if the pain comes, that's the whole point of money links. That's the whole point of pair trading. If we get pain, it's going to be in these interest rate sensitive, these commodity disruption sensitive types of companies that she loads the boat on at the worst possible time. Agreed. If you can find something to short that's going to like lose a lot more money when the rest of the market's getting whacked, then you do that. And that's all I needed to see.
I couldn't agree with you more. Jeff, thank you. I love these sessions with you. I just totally forget that we're being filmed and it's just like you and I are sitting next to each other. So it's I want to say one last thing because we have a lot of fans that love that ARK fund and they love those stocks and they really respect Cathie Wood. And I like a lot of those companies for long-term investment. So I don't want them to misconstrue. They are some of the best companies. I don't want them to misconstrue that. I don't think that like a Teladoc. It's the timing. It's her timing is the future. I do. Yeah. But I'm a hunter and I smell blood in the water. And I started hearing, whispers around the street that guys like 𝗶𝗚 Asset Management, like really shrewd. There are hedge funds and then there are hedge funds. And then I started hearing that really shrewd people were like lining up to short this lady's ETF. And I started digging into why. And I started to see that underperformance. It's kind of like,
it's a trade.
No,
it's a trade.
Again, she's too correlated, and she's too concentrated, and she doesn't time things well. She picks great companies. It's not the companies; it's the timing. I love her companies. Yeah. I love every one of her companies. She picks some of the best companies, but they're too concentrated, and the timing. So
she bleeds out when she gets hit.
Right. Yeah, and again, but yeah. So I think she's a good analyst. I just don't think I think she should get somebody who's quantitative in there to diversify and spread things out. But that's beyond this. Jeff, this was a wonderful session. Thank you again for being here. If anybody wants to reach out to Jeff, please do. Jeff@joyofthetrade.com. Check out Burn Notice. You guys are going to love it. You get in before the end of the day, you get out the next morning. What could be better? I love it. If you want to reach out to me, please do. I won't bite. support@marketgeeks.com. Jeff, this was a great session, and I will see you here next week, and we'll talk before then. Take care, buddy.
Thanks for having me, Roger. Take it easy.
Bye. Take care. Have a great day.
You too.